There's a number you've never voted on, never negotiated, and never directly agreed to. And yet it quietly shapes the price of almost everything in your life. Not your personal credit score. Something bigger. The United States of America has its own credit rating. And when that number moves, even slightly, it sends shockwaves through mortgage rates, job markets, retirement accounts, and the cost of groceries. Most people have no idea this system exists. Even fewer understand who runs it, how it works, or what happens when it starts to crack. Here's what's strange. The country that prints the world's reserve currency, the country that has never technically defaulted on its debt, still has to answer to a small group of private analysts sitting in office buildings in New York and London. And those analysts have, on more than one occasion, looked at the most powerful economy in history and said, "We're not sure we trust you anymore." That's not a metaphor. That actually happened. And when it did, it cost ordinary Americans billions of dollars they never saw leave their wallets. So let's start at the beginning. When you apply for a loan, a bank checks your credit score. It tells them how reliably you've paid debts in the past and predicts how likely you are to pay them back in the future. Low score, high interest rate. High score, better terms. Simple enough. Governments borrow money too, trillions of dollars worth. They issue what are called bonds, essentially I owe us, to investors around the world. Those investors give the government money today, and the government promises to return it later with interest. But how does an investor in Tokyo or Frankfurt decide whether to trust the US government with their money? They can't call up the Treasury Department and ask for a financial history. They need a shortcut. That shortcut is a sovereign credit rating. And the companies that produce those ratings, Moody's, S&P, and Fitch, are not government agencies. They are private corporations. Their analysts study a country's finances, its political stability, its growth prospects, its debt levels, and its willingness to pay. Then they assign a letter grade. AAA is the top. It means virtually zero risk of default. Below that, grades drop through AA, A, B, 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 and further down until you reach territory that investors call junk. Countries at the bottom of that scale often can't borrow at all without paying punishing interest rates. For most of its modern history, the United States sat comfortably at the top, AAA bulletproof, the safest borrower on earth, until it wasn't. In the summer of 2011, the U.S. government was locked in a political standoff over whether to raise the debt ceiling, essentially, whether to allow the government to keep borrowing to pay its existing bills. The fight went to the wire. Lawmakers threatened to let the country default. The world watched. S&P had seen enough. On August 5, 2011, Standard & Poor's downgraded the United States from AAA to AA+. It was the first time in history that had ever happened. The announcement came on a Friday evening. By Monday, global markets had lost roughly $2 trillion in value. The Dow Jones fell nearly 640 points in a single day, one of the largest single-day drops ever recorded. Here's the part that nobody talks about. The United States didn't actually default. It didn't miss a payment. The downgrade wasn't about what had happened. It was about what S&P believed might happen, about political dysfunction, about the willingness of Congress to manage its own finances responsibly. A credit rating isn't just a score. It's a prediction about behavior, and the markets believe it. Now let's follow the money, because this is where ordinary people enter the story. When America's credit rating drops, or even when investors start to fear it might drop, the U.S. government has to offer higher interest rates to convince people to keep buying its bonds. Higher yields on government debt are considered the baseline of borrowing costs across the entire financial system. Think of it like a floor. Everything else, mortgages, car loans, student debt, corporate borrowing, gets priced relative to that floor. When the floor rises, everything else rises with it. After the 2011 downgrade, mortgage rates didn't immediately spike, but the event rattled confidence in a way that introduced permanent uncertainty into the system. And uncertainty in financial markets is never free. Someone always pays for it. Usually, that someone is the person buying a house or carrying a credit card balance. There's a term economists use, the risk-free rate. It refers to the theoretical return on the safest investment in the world. Historically, a U.S. Treasury bond. Every other interest rate in the financial system is essentially that rate plus a premium for additional risk. When the risk-free rate rises, even slightly, the total cost of borrowing across the entire economy climbs. Trillions of dollars in debt reprices, slowly, quietly, without headlines. But here's what makes this system genuinely strange. The agencies doing the rating, S&P, Moody's, Fitch, are paid by the entities they rate. Read that again. The credit rating agencies collect fees from the governments and companies they're supposed to evaluate independently. That arrangement came under intense scrutiny after 2008, when it emerged that rating agencies had given AAA ratings to mortgage-backed securities that were, in reality, built on loans that were almost certain to fail. Those AAA ratings helped funnel trillions of dollars into what turned out to be toxic assets. Pension funds, insurance companies, and foreign governments bought them because they trusted the rating. When the market collapsed, those institutions lost staggering amounts of money. Teachers' retirement funds, municipal budgets, the savings of ordinary people who had no idea what was in their portfolios. The agencies faced congressional hearings, investigations, lawsuits, but they survived. They remained at the center of the global financial system, and they kept the same basic business model. The reason is simpler than you might expect. Nobody has built a credible replacement. There have been attempts to create alternatives. The European Union explored developing a European rating agency after American firms downgraded several Eurozone countries during the 2010 debt crisis. The plan never gained traction. China has its own rating agencies, but they're widely viewed as lacking independence from the state. Academic researchers have proposed algorithmic models that could replace human analysts. None of it has displaced the big three. The reason comes down to trust, and trust in finance is not just about accuracy, it's about coordination. Investors around the world have agreed, implicitly, to use the same reference points. That agreement creates a self-reinforcing system. The agencies are powerful because they're trusted. They're trusted because they're powerful. Changing that would require the entire global investment community to simultaneously shift to a new standard. That's never happened voluntarily in financial history. Now let's zoom out further, because the implications of America's credit standing go well beyond interest rates. The US dollar functions as the world's reserve currency. Central banks in dozens of countries hold dollars as their primary store of value. Oil is priced in dollars. International trade contracts are written in dollars. When crises hit anywhere in the world, investors typically rush into dollar-denominated assets because they believe they're safe. That status, reserve currency issuer, gives America what the French economist Valéry Giscard d'Estaing once called an exorbitant privilege. The U.S. can borrow at lower rates than any other country because global demand for dollar assets is essentially guaranteed. It can run deficits that would be catastrophic for other nations without immediately triggering a currency crisis. But that privilege is built entirely on confidence. If enough large investors began to genuinely doubt America's ability or willingness to manage its debt, if credit rating agencies began a sustained series of downgrades, the dollar's reserve status would come under pressure in a way it hasn't faced in decades. That wouldn't happen overnight. Reserve currency transitions take generations. But the direction of travel matters, and the rating agencies, private as they are, function as one of the primary signals the global financial community uses to calibrate that confidence. In May 2023, Fitch placed the United States on negative watch, a formal signal that a downgrade was under consideration. 2 months later, they followed through, cutting America's rating from AAA to AA+, citing what they called a deterioration in governance and a growing debt burden. It was the second time in 12 years that a major agency had stripped the U.S. of its top rating. The reaction was more muted than 2011. Markets dipped, but didn't collapse. Some analysts argued the downgrade was symbolic, that the U.S. remains an overwhelmingly safe borrower. Others pointed out that Moody's, the only remaining major agency still holding the U.S. at an ADEA, was now under pressure to follow. In May 2025, Moody's did. For the first time in history, all three major rating agencies had downgraded the United States from their highest possible tier. What does that actually mean going forward? Some of the effects are mechanical. Certain institutional investors, pension funds, insurance companies, sovereign wealth funds, are required by their own rules to hold only the highest rated assets. When a rating drops, some of those investors are legally obligated to sell, or at least to reconsider their holdings. That creates selling pressure on U.S. bonds, Selling pressure drives prices down. When bond prices fall, yields, the interest the government pays, go up. Higher yields on government debt push up the cost of borrowing for everyone. But there's a subtler effect that matters just as much. Rating changes shift the narrative. They change what financial journalists write. They change what portfolio managers say in quarterly reviews. They change what foreign finance ministers tell their central banks. Confidence is fragile in ways that don't show up in any single data point. A series of downgrades doesn't just affect prices, it shifts the story that the global financial community tells itself about America. And in finance, stories become self-fulfilling. Here's the question worth sitting with. A handful of private analysts working at corporations with their own financial interests and documented track records of error hold meaningful influence over the borrowing costs of the largest economy in history. They helped enable the 2008 financial crisis. They sparked a global market panic in 2011. And yet their ratings still move markets, still influence policy, and still help determine what millions of Americans pay every month on their mortgages, their car loans, and their credit cards. The system that rates America's creditworthiness wasn't designed by Congress. It wasn't created by voters. It evolved. And it persists not because it's perfect, but because nothing has been built to replace it, which raises a question nobody in power seems particularly eager to answer. If the agencies that judge America's financial trustworthiness can themselves be wrong, and the record proves they can, then who exactly is watching the watchmen?